Just compare deductible lapses in the year it occurs, or theft, the year it is discovered. The amount of the deduction depends on whether the asset is completely destroyed or only partially destroyed. When it is completely destroyed, that was funny. The business calculates the loss by substituting the insurance proceeds for the amount realized. The loss is the amount of insurance proceeds minus the adjusted tax basis of the asset. If the asset is damaged but not completely destroyed, the amount of the loss is the amount of the insurance proceeds minus the lesser of the tax basis or the decline in the value of the asset due to the casualty. Oh, great. Individuals, business casualty losses, and casualty losses associated with rentals and royalties are deducted for AGI. Now we have an example. Suppose Rick acquires business equipment this year for $5,000, but a fire damages the equipment shortly after it is acquired and before it can be placed into service. This is funny because they don't give an example of when some equipment is equipment is only partially damaged and it declined in value or something. Dang. After the equipment was worth $3,500. After the fire, the equipment was... Oh, wait, hold on a second. Oh, never mind. This is an example involving equipment that declined in value because... it's an example involving equipment that was only partially damaged and it declined in value from the damage, obviously. Oh, man. It says you subtract the amount that you subtract, it's the lesser of the tax basis or the decline in the value of the asset. How could the decline in the value of the asset be more than the tax basis? I guess it's because it apparently went up in value after the tax basis, and then it went down so far below. So like you can't, because if you deducted, okay, stop. So it's 1,000 minus the decline in value, dude. So the decline in value was less than the tax basis. The tax basis was 5,000. So clearly you do the insurance minus the decline in value. The decline in value was 1,500, so you get a casualty loss deduction. Interesting. So you subtract the lesser of the decline in value or the adjusted tax basis. So what if it was completely destroyed? That means you can do 1,000 minus the adjusted tax basis, 5,000. It makes sense that because you still ended up with 3,500, so 500, and then you got the amount that you have now is like 4,500 it logically makes sense. It's now worth 3,500, and you just got $1,000 from insurance. So that means you only lost about $500. So therefore, you deduct $500. That's funny. It makes logical sense. It makes very logical sense. I should be fine on this. So, and for individuals, it's only for federally declared disasters. There's a $100 floor and a 10% of AGI floor. And for business, you can deduct it as a it's for AGI because all business deductions are for AGI, right? Right. Well, that was funny. That was funny. So now we've completely finished studying casualty losses. So, for individuals, it's a from AGI deduction, and it's only for federally declared disasters, and it's a floor of $100 and a floor of 10% of AGI. For businesses, it's a for AGI deduction, and the deduction is equal to the proceeds minus insurance proceeds minus either the tax basis or the lesser, or minus the loss or decline in value or something. That was funny. So that means we're done with that one. Dang it, I don't want to read about accrual and cash methods. That's such a complicated thing. Man. So don't want to read about that. Dang it. Accrual and cash methods. No. That is going to be the least fun thing to read about in this entire study session. That was funny. It's going to be so annoying to read this. Man. Like, look at this. Okay, I can skip a few parts of this. I just have to look at cash method and accrual method. I only skipped like a few paragraphs. Man, cash method. Great. This is going to be so fun to read this and also have to understand all this stuff because there's so much complicated stuff related to the two different methods of accounting. Dang it. That was funny. There's so many exceptions to all the stinking rules. It's too hard to memorize all the exceptions. Wow. A business using either cash or accrual method must generally capitalize prepaid interest and other prepayments that create tangible or intangible assets. However, it can be difficult and time-consuming for small businesses to capitalize the multitude of prepaid expenditures that create benefits for a relatively brief period of time. Yeah, but I thought by definition you only have to capitalize something that gives you a benefit for past 1 year. That's fine. Sniffed. You sniffed. How far am I through this study guide? I mean, there's a lot of things on the study guide I don't really have to study because I already know. Like, I recently studied it, or I'm pretty confident on it, so I don't necessarily need to study everything on here. I'm just going through it based on the things that I don't remember. But thankfully now I'm good on casualty loss deduction, Section 481 adjustment, and types of audits. And 13, it's just too broad of a topic to really be able to study it. Like, I tried studying number 13, but it didn't get very far. Man, come on. Hey, I should underline this one because I also did that, so that's fine. You sniffed. Okay, stop. So, regulations provide a 12-month rule that simplifies the process of determining whether to capitalize or immediately expense payments that create benefits for a relatively brief period of time, such as insurance, security, rent, and warranty service contracts. When a business prepays business expenses, it may immediately deduct a prepayment if the contract period does not last more than a year. You sniffed. I will be done with 2 out of my 4 classes by the end of today. That's insane. That's insane. Unfortunately, it's going to take a lot of work to get caught up in my business analytics class because I have 4 assignments that are overdue. That was fine. No, it's going to end up being 5 overdue assignments because there's another assignment due today. That's funny. That's so funny. Maybe I should message my professor about the... I don't think he put it in an announcement, did he? The extra credit for something. I can't remember what he said was extra credit. There was some kind of online course you could take for extra credit, but I don't think he even posted an announcement on here. I don't think it's going to be in the syllabus either. I might just have to ask him about it in person because I might be interested in doing the extra credit. Considering that I have a very high chance of doing badly on the exam and also getting a bad grade on the tax project. That was funny. Sniffy. Stop. You may immediately deduct prepayment if the contract period does not last more than a year and the contract period does not extend beyond the end of the taxable year following the tax year in which the taxpayer makes the payment. If the prepaid expense does not meet both these criteria, the business must capitalize the prepaid amount and amortize it over the length of the contract, whether the business uses the cash or accrual method of accounting. The 12-month rule for prepaid expenses applies to the cash and accrual methods. So, on July 1st, paid $1,200 for a 12-month insurance policy that covers the business property from accidents and casualties. So you can deduct all of the $1,200 because it's only for the next 12 months and it does not extend into the next year. So what if it was for 12 months, but it ran from February of next year through January 1st of the next year? That means you have to capitalize. And how much can you deduct this year? It starts on February 1 of next year, so therefore you cannot deduct anything. That was funny. Suppose that he had paid $1,200 for an 18-month policy. That's obviously 18 months, so you have to amortize. So it begins on July 1st of this year and ends on December 31st of next year. So you can deduct only 6 out of 18 months. So that would be 1/3 of it, which is $4,000. So, yep, that's pretty straightforward. Now, accrual method. So that method, something we just read about, was the 12-month rule, which applies to both the cash and accrual methods, apparently. That's important to remember. That was fun. Dude, this chapter, look at how long I have to read. Like, look at this. Look at this. All the way down. This is going to take forever. Wow, that was fun. What if I have some downtime in between the two exams? It's possible. I don't know if there's going to be anything for me to really study for federal income tax between these. Like, let's see. That was fun. Sniff. Businesses using the accrual method to determine taxable income. Nice. What is included in Schedule A, BA? That's gotta be a mistake. It's gotta be A, B, C, D, and E. And others. Oh, come on, man. What about Schedule 1, 2, and 3? Just to be safe, I'll probably memorize Schedules 1, 2, and 3 as well. Okay. Accrual method. Businesses using the accrual method to determine taxable income follow rules similar to GAAP with two basic differences. First, the requirements for recognizing taxable income tend to be structured to recognize income earlier than the recognition rules for financial accounting. Second, the requirements for accruing tax deductions tend to be structured to recognize less accrued expenses than the recognition rules for financial reporting purposes. These differences reflect the underlying objectives of businesses using the accrual method of accounting generally recognize income when they meet the all events test. This test is sometimes referred to as the fixed and determinable test. I just multi-slotted. I just was an idiot. So, the all events test requires that businesses recognize income when 1. All events have occurred that determine or fix their right to receive the income, and the amount of income can be determined with reasonable accuracy. Assuming the amount of income can be determined with reasonable accuracy, businesses meet the all events requirement on the earliest of the following 3 dates. 1. When they complete the task required to earn the income. Businesses earn income for services as they provide the services, and they generally earn income from selling property when the title of the property passes to the buyer, when the payment for the task is due from the customer. So even if the customer prepays for the service, you still recognize that income, even though it's not, you have not completed the service, because it's the earliest of the 3 dates. And when the business receives the payment for the task. So when the payment is due, even if they haven't paid yet. What the heck? What? When the payment is due? Or when they receive the payment. The earliest of any of 3 things. Even if it's due and they haven't paid yet, that still counts? What the heck? What on earth? That seems weird. Because what if... I don't know. So Rick contracted with a dozen homeowners to landscape their yards. He agreed to do the work for an aggregate of $11,000. They started in the fall and completed the jobs in December of this year. He did not mail the bills until after the holidays. Well, you must recognize income from the work in December, right? Yes, because his right to the income is fixed at year end when they completed the work. Under the cash method, you would not recognize that as income until next year when you receive it. When you receive income. Taxation of advance payments of income. In some cases, taxpayers receive income payments before they actually earn it. Using the cash method, include these payments in gross income in the year the payment is received. When an accrual method, taxpayer must include unearned income in gross income depends on the type of income. Oh, come on. Nothing can ever be simple. That was one. All taxpayers must recognize interest and rental income immediately upon receipt. Okay, so for interest and rental income, even if you use accrual method, you still have to recognize income immediately upon receipt, even if you have not yet earned the interest or rental income. Interest and rental follow cash method regardless, all the time. You must follow the cash method for interest income and rental income all the time. That was fun. Now it went back up to 2 hours and 34 minutes until full. You've got to be kidding me. Why does it keep changing? Whoops, he sniffed. That's fine. Income is recognized when earned, all events, or received if earned. So, under the all events test, income is earned when the business has the right to receive payment or when recognized in applicable financial statement if earlier. Taxpayers can generally elect to defer recognition of prepaid unearned income if the income is also deferred for financial accounting purposes. Well, then what the heck is the point of the all events test of the payment thing? Deferral of income is an accounting method election, and deferred income must be recognized in the year after deferral. The tax deferral only lasts for 1 year. So, for interest and rental income, you cannot defer income. For interest and rental income, you have to recognize it right as you receive the payment. For other types of income, accrual method businesses can elect to defer the recognition of unearned income for 1 year. Specifically, businesses using the accrual method may elect to defer recognizing advance payments for goods and services until the next tax year. This one-year deferral method does not apply if the income is actually earned by the end of the year of receipt, or if unearned income is recognized for financial reporting purposes. In addition, this is an accounting method election that, once elected, can only be revoked with the permission of the Commission. Okay, in late November 2022, Rick received a payment in advance from a client for monthly landscaping services that start on December 1st, 2022 and go through November 30th, 2024. When do you recognize the income from the advance payment? Okay. Oh, man, this is so confusing. This is so confusing. Okay, let's see here. Let's see. When must you recognize the income here? It looks as if you recognize December. You have to recognize the December income here. You have to recognize that. So, so we have $300 a month. So $300 must be recognized this year. And then here's the key fact. There's a certain amount of it that you must recognize. So here's how much you deferred. Here's how much of it you deferred. You deferred $6,900 worth of payment for 1 year. So $300 is recognized in 2022, and then the entire rest of it has to be recognized in 2023 because you're only allowed to defer the payment for 1 year. That's what I'm getting from this. What is the answer? Please tell me that's the answer. Yes, I was correct. Ha ha ha. I was correct. You have to recognize the entire rest of it because you're only allowed to defer the recognition for 1 year. I think I may have gotten that wrong on a quiz or test earlier in the semester. But now I understand the concept. That was funny. If he does not elect the deferral method. Okay, what does he do if he does not elect the deferral method? That means you recognize the income all at once, right? Yep, exactly. And under the cash method, you recognize the entire prepayment as income upon receipt. What is the next scenario? The next scenario is... Okay, fine. Suppose that rather than receiving payment in advance, the client paid $7,200 in 2022 for landscape supplies. Okay, so they paid, instead of for services, they paid for supplies. Okay. Why is this a different scenario? What's the difference? What is the difference here? Okay, I believe that you don't have to recognize any income for 2022 because he didn't even provide any services or goods at all in 2022. So that's my answer, right? Hey, I was correct. Yay! Less cost of goods sold. Yep. Yay! I got all the example questions correct without reading the answers. Yay! Stop. Oh no. We're not even close to the end of the section though. Because the stupid idiotic study guide just says accrual and cash methods. It doesn't say anything else more specific than that. So I have to read the entire section. It's such a long section to read. Man. Man. Okay, so regardless of whether the taxpayer uses the cash or accrual method, you must use the accrual method for accounting for inventories. And all taxpayers must use the accrual method for accounting for purchase and sale of inventory. The cost of inventory must include the purchase price of raw materials minus discounts, direct costs, manufacturing, the shipping costs, and any indirect costs allocated to the inventory under the Uniform Cost Capitalization rules. That's fine. Inventories. C corporations and partnerships with C corporation partners must use the accrual method to account for inventories unless they qualify as a small business under the gross receipts test. Dude, what if he asks a question about the gross receipts test? I'm going to be so... I would not put it past my professor at all to ask a bunch of questions that have nothing to do with this stuff. I think that's what he did. That's how he always does it. He gives you all these things to study, but then he adds a bunch of other stuff to the test. So thanks a lot, dude. Thanks. Thanks. Must use the accrual method to account for inventories unless they qualify as a small business under the gross receipts test. Small businesses can account for inventories either as non-incidental materials or use the inventory method used for financial reporting. The UNICAP rules require capitalization of most indirect costs of production, but businesses that qualify as a small business under the gross receipts test are exempt from UNICAP. The LIFO method is allowed if it is also used for financial reporting purposes, a conformity rule. Under Section 471C, small businesses qualifying under the gross receipts test discussed previously can opt to account for goods as non-incidental materials or use the accounting method that conforms to the taxpayer's financial accounting treatment of inventory. Generally, non-incidental materials are tracked on the taxpayer's books and records. Either through records of consumption records of consumption or by periodic physical inventory. Amounts paid to acquire or produce non-incidental materials are generally deductible in the tax year in which the materials are used in the taxpayer's operations or are consumed in the taxpayer's operations. The IRS interprets used or consumed to mean that non-incidental materials are deductible when taxpayers sell the inventory. For example, suppose a company stores machine repair parts for which it keeps records of purchases and consumption. The company can choose to treat the parts either under the method conforming to its financial accounting or as non-incidental materials. If the parts are treated as non-incidental materials and the parts are used in the business, the company can deduct the costs of parts in the tax year the part is removed from storage. If, however, the parts are a component of a finished good, then the cost of the part can only be deducted at the time that the taxpayer incurs the cost or delivers the finished goods, whichever is later. The ability to account for goods as non-incidental materials was intended to simplify accounting for small businesses by exempting them from having to allocate indirect costs to inventory. However, small businesses are still required to record beginning and ending inventories, even when the business chooses to treat goods as non-incidental materials or use the inventory method on the taxpayer's books. In addition, small business accounting for inventories is subject to the overriding requirement that all accounting methods must ultimately clearly reflect income. Suppose that Green Acres commences to manufacture an organic lawn supplement. One to 250. Oh my gosh. There's an exam at 1 p.m. and 3 p.m. 1 p.m. and 3 p.m. Oh man. Oh man. One p.m. and 3 p.m. 1 and 3 p.m. It's funny, our exam for the other class takes place at the exact same time that our class normally takes place, except it's longer. And also my exams are only 10 minutes apart. And it takes way less than 10 minutes to walk in between classrooms, so it's fine. That's fine. And plus, I might finish the exam early. So anyways... Let's go. That was... Stop. That's fine. So... that was fine. Are we reading the example? Commences to manufacture an organic lawn supplement. It will purchase compost from local farms and blend the compost with minerals. Then package the mix and sell the packages to local retailers. Would they be required to keep inventories of raw materials, work in process, and goods for sale? I think it's no, because he's a small business. I think it's no, right? What? Oh, come on! Oh, wait a minute. It says... Green Acres must keep inventories because producing and selling goods is an income-producing activity. However, because it is a small business under the gross receipts test, Green Acres need not use the accrual method of accounting for its purchases and sales. Green Acres either can elect to treat the raw materials, work in process, and finished goods as non-incidental materials, or can use the accounting method that conforms to the method Green Acres uses for financial reporting. In either case, they must keep records of its beginning and ending inventories. What if... oh, I already saw the answer to the question. Dang it! Suppose that they purchased and paid for compost in 2022. And elected to account for the purchase as non-incidental materials. However, the compost was used in producing lawn supplements sold in 2023. Can you deduct the cost of the compost in 2022? I already saw the answer was no. Come on. Why not? Okay, the reason is that non-incidental materials, you must recognize the cost of the material when the final product is sold, I think, right? Dang it. The cost of the compost used is deducted in 2023. The cost was incurred in 2022. The deduction is allowed in the year the goods were delivered because it is the later date. So it looks like that's what happens there. Uniform capitalization. So large businesses are generally required to capitalize more costs to inventory for tax purposes than they capitalize under financial accounting rules. Under GAAP, businesses generally include in inventory only those costs incurred within the production facility. In contrast, the UNICAP rules require businesses to allocate to inventory the costs they incur inside the production facility and the costs they incur outside the facility to support production or inventory acquisition activities, for example, under the UNICAP provisions. A business must capitalize at least a portion of the compensation. Okay, so how much of it would be allocated? Well, it'd be 5% of 30,000. I mean, obviously, the heck, it's too easy. So, what if? No, you do not have to apply a unit count. 27 million is the cutoff for gross receipts for 3 years average. Oh, and also you have to. Okay, so 5 million, but it has to be analyzed. So 5 times. Second 4 divided by 12. No. What on earth? I thought it was times 4 over 12. No. That doesn't make any sense. 5 million is not allocated to the whole year. It's so weird because to expand the 5 million to the full year, divide it by 4 and then multiply it by 12. And then that's the amount for the full year. 15 million. I know how to use FIFO, LIFO, and NIFO, and IFO, BIFO, and LIFO, and SIFO, and IFO. I don't need to study LIFO and LIFO and IFO and SIFO and NIFO. So I'm just going to completely skip over LIFO because That was funny. You sniffed.